All right. Hey, everybody. This is Eric Burkholder.
Gabe West.
We are here today to talk a little bit about inflation. It's been a pretty hot topic.
A lot of headlines on the CNN, CNBC, Twitter, wherever you get your news. A lot of inflation talk. For sure.
Yeah. So, and we've written about it a few times. We'll post a link to our articles, but figured we'd jump on here and do a little video too, because it's a little bit easier to talk about than read sometimes. So,
what is inflation?
Yeah, for most people, it's just prices going up on the things you buy, whether it's at the store or a home purchase or anything else. So that's the non-economic definition. Just prices are going up. So there's a lot of different causes for that. We have some opinions on kind of what's going on right now.
Yeah. Well, why right now is inflation in the headlines?
Yeah, so it's in the headlines because inflation is high right now across the board, a lot of different things, especially housing and even at the grocery store. And so coming off of the 2020 pandemic year, where you had just a really strange situation where demand just fell off a cliff, but it rebounded probably quicker than we've ever seen historically. So as things fell off the cliff, you had factories and mills and all sorts of things kind of cut back because we didn't know what the future held. And then demand was temporarily reduced. People kind of weren't buying houses or buying bigger ticket items. And so all of a sudden all that came back, but all the supply is not there. So very unique situation.
I remember looking at like airline tickets back in April 2020 because no one was traveling or you couldn't really travel. The tickets were really, really low. Yeah. And so now everyone's getting back out and traveling. The airline tickets are more expensive. And so little deflation there and then prices going back up to inflationary prices. So with all that, why does it matter? Things are just going to, I can't control the price of coffee at Starbucks. So how does this matter for a plan? What does this all mean?
Yeah, great question. So I think there's probably two different things there. One is short term, and you just kind of hit the nail on the head. Is there's not a lot we can do. On the supply side, factories and plants and the places that are producing things are not going to just ramp up their production because demand probably is temporarily high.
Yeah.
And so you really are just going to have to wait for some of this to work through the system. And so what that means is if you can avoid buying a house or avoid purchasing some big ticket items right now, and if you have any flexibility in your budget, that's the best you can do is control what you buy.
Interesting. And that's something I wanted to say was that inflation is really an aggregate of a bunch of different things. And so it's the aggregate of all prices going up or going down. So the price of coffee at Starbucks may be the same. Or I think Chipotle, that was one headline, is increasing by 4% per chicken bowl or whatever they have. But lumber prices were going up 50%. So it's not everything goes up a solid 4 to 5%. It's not like everyone agrees that the price shall increase this way. Every single different item has a different range of things, and the aggregate is inflation.
Yeah, and that's the number that you're seeing on CNBC, and that's a great point. So if you again have the flexibility to maybe shift your purchases a little bit for the time being to some of those items that might not be going up.
Yeah.
Obviously, groceries and things like that, it's hard to avoid.
Used cars, that was one that was really inflationary. So if you could hang on to your car a little bit longer, maybe do so, or even think about selling it. That was an item that caused a lot of questions and concerns. So just the different prices of things can.
Yeah, that's a great point. You don't need to buy a used car right now based on price. I mean, you got to do what you got to do, but if you can wait, you should wait. Just similar to investing, it's weird. A lot of these products that we buy tend to kind of have this herd mentality. So as inflation goes up, people get more nervous that they're going to run out of used cars, and so they start paying more higher prices.
Interesting.
And so that psychological piece of it can be dangerous and it really drive things up extremely high. So if you can wait, I would wait.
Discussing portfolios and transitioning into that. Inflation, it gets really scary, 3, 4, 5%, 10% inflation numbers from whatever article you read. It sounds really scary. So should I go a little bit more conservative in my portfolio? Things are looking scary out there, or do I go more stocks, more bonds? What do I kind of do to kind of offset what's happening out there?
Yeah, great question. Question we're getting from clients a lot. I think the first thing is when we think about investing, we want to do things that will withstand any type of market situation. We know things are very volatile, very uncertain. Inflation is certainly one of those factors that go into that equation. And so we often teach against trying to make a bet on any one thing happening.
Okay.
Inflation is a perfect example. Since 2009, or end of 2008, 2009, when we had the first TARP bank bailout and cash infusion. I mean, people have been talking about inflation for over 10 years now, and we just haven't seen it. And so in hindsight, if you made a bet in 2009 that we're going to have huge inflation and bought a bunch of tips or some inflation hedges, it wouldn't have worked out very well. So we try to build portfolios and invest in a way that protects against a bunch of different unforeseen things, but we're not ever going to bet on one direction or the other. So I think that's an important thing. But that being said, we are having inflation. It is a danger to a portfolio, and there are some things you can do in there that will protect against inflation going forward. And I want to make another note. Low levels of inflation are typically considered good.
Yeah.
So because it's very hard to hit the nail on the head and get exactly nothing, so you're really looking at either inflation or deflation. Most economists would agree deflation is not good. We don't want to be in a deflationary environment. Mm-hmm. And so this low level, the Fed actually targets a low level of inflation. And so a little bit of inflation is not a bad thing. But again, we want to protect our portfolio. So going back to your original question, there are some things we can do.
An example of deflation, why we like inflation over deflation, someone discussed it to me. Imagine if you were a student at university and you got some student loans and then the dollar deflated, went really down, then you would need to get much, much more to pay off your loan because the loan value would still be $10,000 or whatever it is. But now you're getting less and less dollars because things are deflating. And so if you do have deflation, then you have all these people with outstanding debt that can't really ever pay it back. And that's a crisis.
Yeah.
So, we see the headlines of inflation, but also deflation could be and is typically more a worse outcome if we had a -2 deflation rate going on in perpetuity. But so that's why we target inflation.
Right.
The better of the two.
Right. Exactly. Great point. I mean, I don't think anybody wants to. College is expensive enough. You don't want the $100,000 you own to turn into $200,000 during inflation. So we're going to have inflation, hopefully, a little low level of inflation, but we're not going to get it perfect, and that's why we build your portfolio to take into consideration inflation. And when we look at this longer term 2 to 3% inflation that we've gotten for a long period of time, that's why we always talk about people who are very concerned about market risk. But for our clients who are either saving for retirement or retired, the purchasing power and losing the ability to pay for things because prices are going up is probably the biggest risk to their plan period. Just people don't appreciate it as much because that's kind of it's off in the future. We can't really see it. We're more concerned about today. So going back to your original question is what can we do in our portfolio to protect against inflation? I think first and foremost is maintaining enough equity exposure. Equity is the stock market. Investing in companies. Typically, most of those in the country or the area we live in. And so retirees tend to go conservative very quickly, meaning buying bonds and cash.
Mm-hmm.
Bonds with fixed rate of return. So if we have inflation, really that interest rate you're getting is slowly getting less over time, right? Assuming inflation is going up.
Okay.
And we were just talking about this earlier, Gabe, maybe you want to jump in on the stock market and investing in companies is a little bit different, and their ability to continue to go up and earn money despite.
Yeah, so Chipotle, I mentioned that earlier, an easy example. It's actually a publicly traded stock, so it's an equity that we would invest in. And, let's say, so the supply chains of the pandemic year lows, everything, and they need to increase prices. They have the ability to do so. So they can adjust for inflation. And so across the broad market, all these different companies kind of within reason have control over their prices or how they react to inflation. And so because they have that ability, they're better suited towards inflation. That's what I'm hearing, what we're discussing.
Yeah. So over the long term, companies that you invest in through the stock market equity exposure have done a really good job of offsetting with inflation risk. Mm-hmm. And so, everyone's situation is different, but, we see most retirees who consider pretty conservative, at least 60% of their portfolio is in equity exposed to the stock market, if not more. And so you want to maintain a healthy exposure to equities. That's the right way to protect yourself against inflation. And it may make sense to maintain more equity exposure right now as you're getting close to retirement, as opposed to 1980 when you could buy a bond and get 18%.
Yeah.
So much different situation, but it's going to go back to your personal situation. But if you have an ideal portfolio for you and your situation, you might be a little bit more on a little bit more equity exposure than maybe you would have in the past.
Okay. So the inflation kind of eats into bonds a little bit, and then definitely eats into cash. So what's kind of a general, piece of advice you would say for someone who's holding large amounts in cash or kind of an emergency fund? What?
Yeah.
What do you say to that?
That's another big problem is cash is not hurting anything. Mm-hmm. The Fed rates are essentially zero. Even buying, long-term government bonds or intermediate-term government bonds are getting less than 2%. And so bonds and cash are kind of the safety valve of your portfolio. There as that cushion and safety, but right now it's very expensive. We call it kind of insurance on your portfolio, right? It's a very expensive insurance right now. Any excess cash or bonds you're holding, you're paying a very high rate, meaning you're earning very little, and after inflation, you're losing money. And so something you want to be aware of is, how much do I really need in cash? And if you have more than that, you really need to look at putting it to work. And that number is going to be a little bit different for everybody, but typically that emergency fund is 3 months living expenses, 3 to 6, somewhere in that range. If you have more than that, you really need to start looking at how can I put this to work, because I'm probably not going to need it. Can I get in something that could pay me a little bit more than cash to keep up with inflation?
Interesting. And so you could maybe rotate a little bit out of cash if you consider that your sideline, or you may push more of it into some equities or just your overall allocation. But again, not necessarily trying to time it. Like I'm not going to put all a bunch of money into a certain asset class or a certain stock because inflation's higher than right now, so I'm going to put it all in that. Because like you said earlier, 2008, that wouldn't have gone over very well if you would have bet on inflation.
Right.
You're going to have to bolt it down and expect inflation or expect various ranges of inflation.
Right. That's a big, big important piece because, like we said earlier, and you said, we really don't know. I mean, you'll hear a lot of opinions on TV. We obviously have an opinion as well. We think the current high inflation is probably more temporary. But the fact is, we just don't know. And so solid investing never requires us to know what's going to happen. We take a lot of different potential outcomes and build a portfolio around that. And so, yes, and again, if you have cash, there for a reason because you have planned purchases. You maybe have a job that's more volatile. That just needs to stay in cash, and there's not a lot of other options you have because it's not a thing where we can throw it in the market and then we'll just pull it back out, in 6 months or so. That's not how it works. So, when we talk about protecting against inflation, it's something, an investment strategy that you're willing to stick with even if we don't see inflation.
Okay.
But on the cash side, maybe if you're not quite ready to go fully into the market, there are some other options. We really like I-bonds. So I-bonds you can purchase directly from the government, treasurydirect.gov, I believe is the website. And so they're inflation bonds. The rate that you get paid for them is tied to the inflation rate. And so really good hedge against inflation. They are considered probably short, maybe a little short, I would say short plus, like they're not intermediate, but the reason why I say short plus is if you do sell it within the first 5 years, you'll lose 3 months of interest or 6 months. I need a fact checker. We'll see. Hey, Meadow, can you check if it's 3 or 6 months interest on the I-bond? We'll get back to you. But even if you were to sell that I-bond, say in 12 months after your first purchase, that rate, even after losing a small piece of it, is still, let's see, I got my notes right here, 2.65% based on the current rate.
Okay.
So much healthier than
0% from in my checking account, or the .00001 in my savings account. It should be rotated into that. There is a $10,000 cap though.
Correct. Yeah. And that's per couple. So a couple could do 20. And then that's right. And that makes sense, I think, for this type of investment, especially if you're considering like a quasi, like cash plus, there's probably better ways to diversify. I would probably, everyone's situation is different, but if you're putting in 20,000 a year, that's probably plenty. But again, it just depends. And yeah, so I think at the end of the day, you want to still take a long-term approach.
If anything, if you can get anything to take away from our talk, we could get into so many little weeds of what makes up how they calculate inflation, all these types of things. But I guess the great thing, you want to just not worry about it, not get freaked out by the headlines, just focus on the long term. And the long term inflation, everything seems okay if you have a plan in place.
Yeah, exactly. And Meadow just is reporting back, yes, 3 months interest is what you lose if you cash it in before 5 years. So like we said, right now, at least even after that quote penalty, you're still getting really healthy interest rate. And so, to Gabe's point, this all goes back to your plan, right? And an investment is part of your plan, right? So all this really the right decision for you is, what is your plan? Are you working? Do you have 20 more years to work? Are you about to retire? Are you retired? How much assets do you have relative to what you're spending? All those things ultimately are very important and will be the foundation of your plan. And then inflation is just kind of one little piece of it.
Yeah. Hedging our bets here a little bit in discussing that there's not a one size fits all answer to inflation.
Right.
Really, that one size fits all is your own individual plan. And so I think on the headlines and the stuff, we like to see what can we do during a high inflation time, and I guess that's not how to look at it.
Yeah, no, I mean it would be literally like trying to redesign your home every time there was a tornado warning.
Yeah.
Right? Like your home has to be, especially if you live in Oklahoma like we do, you have to have some precautions in place. Maybe you have a storm shelter. There's one within close driving distance, but you don't completely change, pay construction crew to come in and change your house because there's a tornado warning. Like your house has to potentially be able to withstand the tornado. It also has to operate and serve you and your purposes if the tornado doesn't happen.
Yeah.
So inflation is kind of the same way. It may happen, it may not. We can't just completely change everything because it might happen, but we do want to be prepared for it. And you build your home on a foundation of what you need for the next 30 years, not what the weather's going to be next week.
I like that analogy. The tornado warning.
Yeah. So we have an inflation warning right now. It's not comfortable. We don't like seeing people pay more for stuff, but hopefully our thought is that it's more of a temporary supply demand problem, and that will start to clear up. Hopefully in the next 6 months, we'll see. So hopefully that's helpful to you guys. Like I said, we'll link to the article we wrote recently, and I'm sure you'll continue to hear stuff about inflation. And if you have any questions,
we would love to discuss way more in the little details if we had the time to. We could go there. So.
Yeah, we'll leave it there for today, and we'll see you guys back here another time.